Hello everyone, hope you are fine. In this lecture we see that how many types of financial statements a business should prepare, and discuss the first type in detail, that is, statement of profit and loss. Let's start. Basically, there are 5 types of financial statements. Number 1, statement of profit and loss, SPL. Number 2, statement of financial position, SOFP. Number 3, statement of changes in equity, SOCIE. Number 4, statement of cash flows, SOCF. And last one is notes to the accounts. Let's move on to our main topic, that is statement of profit and loss. Before we begin to discuss the format of this statement, there are some important points must be noted about statement of profit and loss. First point is that, what's the main reason or purpose to prepare this statement? And the answer is, the SPL basically defines the profit or loss of a business for the current accounting period. In simple words, SPL states that, in the accounting period, a business either make a profit or incur a loss from its sales. It also shows the cost of inventory sold, gross profit, revenue, expenses and net profit. And alternative names of statement of profit and loss are SOCI, statement of comprehensive income, or income statement, or a profit and loss account. Now we come to the part where we talk about the format of income statement. When preparing an income statement, first write the name of an organization or business. Suppose ABC is a business, the income statement of which we are preparing. After writing the name of the business, next we write the name of the financial statement. Just as we are preparing an income statement, so we are writing a statement of profit and loss. Then write the reporting date and year of the business. The date at which the financial statement is prepared is called the reporting date. An important point is that the statement of profit and loss reflects the effect of the transaction on the business, which takes place throughout the year. So, in preparation for the SPL, we write for the year ended, and then write the reporting date and year. However, when we prepare a statement of financial position, we write as the year ended, because SOFP reflects the financial position of the business at a time, not throughout the year. Let's move on. The income statement has 2 columns, internal and external, also called inner and outer column. First, we record sales figure in an outer column. The formula for calculating sales statistics is to multiply the sale price by the number of units sold. Note that SPL can prepare with the units sold, not with the units produced. And if a sales return or return inward is given, it must be deducted from the sales figures. Next, we deduct the cost of sales. Cost of sales can be calculated as opening inventory plus purchases minus closing inventory plus carriage inwards. If purchase return or return outwards are given, then it can also deduct from purchases. Their individual balances are listed in the inner column, and the total in the outer column. Point to be noted that, while calculating the cost of sales, we consider only production cost. Now we discuss the items used in cost of sales. First one is opening inventory. Basically, it is the closing stock of previous year. The inventory which is unsold last year becomes the opening inventory of current year. Then purchases. This is inventory, which has been purchased in a current year, for resale purpose. Purchase calculation formula is the number of units purchased, multiplied by the purchase price per unit. Next, closing inventory. The unsold items of current year, or the items, which remains in our stock at the year end is our closing inventory. Last item is carriage inwards. It is related to the purchases, also called a transportation cost. As the arrow shows, carriage inwards is the cost of shifting or moving. the purchased inventory or raw material from market to the company's premises. It's all about the cost of sales. After this calculation, we get the gross profit and write its value in the outer column. Formula use in questions to calculate gross profit is sales minus cost of sales. In the next step, we add all the other business income to the gross profit, like rent received. This is the rental income of the business, and its double entry is debit, cash, credit, rental income, then interest received. One thing, note that interest received as income and interest paid as an expense. Next, discounts received. Basically, we say this is non-cash income because we don't get any cash in this case, but it's income in a sense that we pay less than the actual price for the purchase, and we save our cash. Double entry of discount received as debit, payables, and credit, discount received. Then add or deduct profit or loss on disposal respectively. If the selling price of non-current assets is greater as compared to its net book value, then business earn profit on disposal. Otherwise, it suffer a loss. Here are just a few examples of other income are mentioned. There are other types of incomes like dividend received on equity, etc. Similarly, their individual balances are listed in inner column, and their aggregate figure is in the outer column. And this aggregate figure is added in gross profit. Then we deduct the other expenses of a business. This includes electricity bill, double entry of this expense as debit, electricity bill expense, and credit, cash. Or in case of unpaid expense, we prepare a credit entry of payable as a business current liability. Other expenses include wages and salaries expense, repair or maintenance expense, and also a bad debt. It is also called a receivable expense. Double entry to record bad debt expense is debit, bad debt, and credit, receivables. Last point in other expenses is carriage outwards. Previously we discussed carriage inwards, that is related to purchases, and carriage outwards is related with sales, also called a selling cost. Basically, it is the cost of transferring or delivering finished good inventory in the buyer's premises. Some students are confused at this point. Why carriage outwards not added in cost of sales? The answer is that, according to management accounting, direct material, labor, expenses, variable and fixed production overheads all are included in production cost. And selling, admin, distribution, finance and research costs are non-production cost. As we discussed above that, in cost of sales, only production cost is included, as carriage outwards as a selling cost and non-production cost. That's why it is included in other expenses instead of cost of sales. Again, the aggregate figure is listed in outer column, and deducted from the balancing figure of gross profit. In the end, we get a net profit or loss. And for numerical questions, formula used to calculate the net profit is gross profit plus other income minus other expenses. It's the format of income statement for sole trader in a partnership business. For a limited liability company, the format is slightly different from that. In future we discuss that format also. I tried my best to teach you this lesson. If still any question in your mind related to this, then leave a comment. Thank you.